March 11th, 2026. Shit is about to hit the fan. And if you believe everything is fine in America, then you have already lost, or you're just happy with your shiny objects that keep you broke. I will leave the video I watched so you can listen to it for yourself and make up your own mind. Today we need to talk about something that a lot of people in the financial world are starting to whisper about. Some analysts believe that the conditions that caused the financial crisis of 2008 may be quietly building again. Not in the exact same way, not in the exact same place, but the warning signs are starting to look familiar. And if you're an investor, ignoring those signs can be very expensive. Like and subscribe, The $1 Investor. The lesson from 2008. Before we talk about what's happening today, we have to remember what actually caused the crash of 2008. Most people think the crisis was caused by the stock market falling. That's not what happened. The crash started inside the credit system. Banks were making risky loans. Those loans were bundled into complex financial products. Then those products were sold all over the world. For years, everything looked perfectly stable. Housing prices were rising, investors were making money, and nobody believed the system could break. Until suddenly, it did. Once borrowers started defaulting on their mortgages, the entire financial system started collapsing. Banks stopped trusting each other, credit froze, and the global economy nearly fell apart. Now here's the uncomfortable question. What if the same type of hidden risk is building again? The debt problem. Today the world is carrying more debt than ever before. Governments are heavily in debt. Corporations are heavily in debt. Consumers are heavily in debt. And for years, that debt wasn't a huge problem because interest rates were extremely low. Borrowing money was cheap. But that environment has changed. Interest rates are now significantly higher than they were just a few years ago, which means the cost of servicing all that debt is rising. Companies that borrowed cheaply before may now struggle to refinance. Governments are spending more on interest payments. And the financial system becomes more fragile when debt levels get this high. But debt alone isn't the biggest concern. The real concern is where the risk is hiding. The rise of private credit. One of the biggest financial trends of the last decade has been the explosion of something called private credit. Private credit is exactly what it sounds like. Loans that are made by investment funds instead of traditional banks. These loans are often given to companies that might not qualify for standard bank financing. And this market has grown incredibly fast. Over the last 10 to 15 years, private credit has expanded into a market worth well over $1 trillion. Now, growth by itself isn't a bad thing, but rapid growth in lending always raises an important question. Are lenders taking on too much risk? Some analysts believe that private credit today could resemble what subprime mortgages were before 2008. Loans being made to riskier borrowers, loans being packaged into investment funds, and investors chasing higher returns without fully understanding the risks. But there's another problem with these funds. Liquidity, the liquidity trap. Many of these private credit funds promise investors that they can withdraw their money whenever they want. But the loans inside those funds are not easy to sell. They're not traded on public markets. They're often long-term loans to private companies, which means if a large number of investors try to withdraw their money at the same time, the fund could face a serious problem. They may not be able to sell the assets quickly, and if they are forced to sell quickly, they may have to sell at deep discounts. That's how financial stress spreads. One fund limits withdrawals, investors panic, other funds face pressure, and suddenly the problem spreads through the financial system. That's the kind of chain reaction that caused the crisis in 2008. Market concentration risk. There's another risk building in today's markets: concentration. Right now, a small number of massive companies are driving a huge portion of the stock market's performance. Technology companies, artificial intelligence companies, mega-cap firms with enormous influence over the indexes. When markets become too concentrated, they become fragile. If just a few major companies stumble, the entire market can feel the impact. This doesn't mean those companies are bad investments, but it does mean that the market may be more dependent on them than investors realize. And when too much money flows into the same assets, volatility increases. Why this is different from 2008. Now, it's important to say something very clearly. Today's situation is not identical to 2008. Banks are stronger than they were back then. Regulations are tighter, capital requirements are higher, financial institutions have gone through years of stress testing, but risk doesn't disappear, it moves. And many experts believe that a lot of today's financial risk has moved outside the traditional banking system. into hedge funds, into private credit markets, into asset managers and private investment vehicles. That makes the system harder to monitor and sometimes harder to stabilize if problems appear. What investors should remember. Whenever people start talking about financial crises, fear spreads quickly. But the goal isn't panic. The goal is preparation. History shows us something very important. Financial crises happen, but long-term investors who stay disciplined still build wealth. The key lessons are simple. Diversification matters, liquidity matters, risk management matters, and most importantly, time in the market matters. No one can predict exactly when the next crisis will happen. But we know one thing for certain. Markets move in cycles. Boom, correction. Recovery, growth. And the investors who survive those cycles are the ones who stay consistent. Closing summary. The biggest financial crashes in history didn't come from obvious problems. They came from risks building quietly beneath the surface, hidden in complex systems, ignored during periods of optimism, and then suddenly revealed when something breaks. That's why smart investors stay humble, because the market can do anything, at any time, and the best strategy is always the same. Consistency, discipline, and patience. Like and subscribe. The $1 Investor.